Hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, along with my co-host, as always, Lindsay Wilson. How are you, Lindsay?
I'm great, Joe. Show is done, and I get a little bit of time off before I begin my next one. And so
Yeah, I
I'm
was just going to ask you, what are you going to do with all your time now?
that's a great question. I have about a month, and then I'll be doing another show at Fourth Line Theatre in Millbrook, Ontario. So if you're in the area, it's called Jim Watt's Girl Reporter in August. Never too early to plug the show.
Absolutely. Okay.
And
So,
how are you,
Lindsay,
Joe?
oh, I'm good. I'm good. I don't think anything new and exciting. Lots of kids' sports. It's keeping
Oh
me busy
yes,
right now.
no doubt.
So today we're going to talk. This is going to be more specific to business owners, and we're diving into business owner compensation planning again. We're going to have a little heavier tilt into thinking about the actual cost of CPP for business owners, because one of the things that comes up often in reasons why you should pay yourself a dividend instead of salary is the fact that if you pay a dividend, you don't have to pay into CPP. So we don't think it's as simple as thinking of it like that. So we're going to dive in a little deeper. And we have my friend and a fellow advisor, Aravind, on the show today. And he's done some kind of I guess, deep dives into these different points on CPP, some of the content he's created. So I thought it'd be great to have him on it and chat with him a bit about it.
Absolutely. So, a little bit about Arvind. Arvind Sithamparapillai is an associate at Ironwood Wealth Management, where he focuses on financial planning for three main clientele: midwives, sales professionals, and incorporated business owners with profits under 500,000. And one of the things he enjoys doing is thinking deeply about financial planning and the intersection of life, happiness, and money. He also writes vlogs about this topic often. And when he's not, as he puts it, when he's not nerding out on personal finance, you can catch him making new friends at conferences, volunteering at his church, and having wild and crazy dance parties with his wife and three kids.
Sounds like a lot of fun. I
So
hope
it does
everyone
sound like a
enjoys the
lot of
show.
fun. Yes.
Thanks, Lindsay.
Thanks.
All right, Aravind, welcome to the show. How are you today?
I'm good, Joe. How you doing?
I'm great, thanks. I'm excited to have you on. We're talking about one of the topics that I find fascinating and just a lot of fun to talk about. So, not all of our listeners are business owners, but today we are going to be a little bit more business owner focused. And you've done a lot of writing recently around this business owner compensations piece, specifically thinking about CPP, where a lot of times when when people are making recommendations around business compensation strategies, so how business owners are taking their income, whether they're taking salary or whether they're taking dividends, a lot of times one of the things that comes up is, well, you should just take dividends because then you don't have to pay CPP and you can do whatever you want with that money, invest it in your own or whatever it is. But I know one of the things we're going to talk about today is how maybe we shouldn't just lump things into a kind of a one size fits all, and we should kind of zoom out and look from a bigger picture when we're making these decisions. And so I know you'll talk a little bit about the CPP and how we can really look at that, whether it's an expense or an investment, and how expensive it really is. But we'll touch on some other concepts when it comes to this planning. So maybe you could start by telling us, we'll just jump right into tax integration and the differences in total tax, if any, between paying yourself a dividend versus paying a salary.
Great question. So, first of all, for anyone that doesn't understand the idea of tax integration, it's the idea that if you pay yourself just a single dollar, let's flow that through a corporation. So, if you didn't have a corporation and you earned a dollar personally as income, or you set up a corporation and you say, hey, that corporation is going to earn the dollar, and then eventually I'm going to get that dollar out of the corporation, whether through using that corp to pay myself a salary, or the corp pays profits and then I pay a dividend out to myself. The idea with integration is the amount of tax that goes to the government in both of those situations is close. Ideally, integration would mean that it's exactly the same, but in most provinces, it's close. And I mean close in that in Ontario, as an example, it's about 0.2 to 0.25% difference. So if you pay yourself a salary, for every single dollar that you paid yourself in salary, you pay 2.5 cents less tax than you would if you paid yourself in dividends. But it's so close that from a tax perspective, it's almost irrelevant. Almost. Any questions about that, Joe?
No. So, or maybe I'll dive a little bit deeper into that. So, in other words, again, we're going to talk about the CPP piece, but forgetting about CPP, at the end of the day, I think what I hear you saying is whether as a business owner, I pay myself dividends or I pay myself salary, I'm going to be paying this basically the same amount of tax.
Almost the same amount of tax. And actually in most provinces, you're actually paying a teeny tiny bit more tax when you pay in dividends. Now, again, 0.2, 0.25% is such that we're looking at it being like, oh, sorry, in Ontario, let me take that back, 0.59%. But that means if you're paying $100,000, we're talking about a difference of like $500, $600. So it doesn't feel like a lot, but it's a very little bit amount more of tax if you chose to take that money through as dividends versus salary.
Okay. Now we're going to talk about the CPP piece in a minute, as I mentioned, but could you make an argument for why maybe someone would want to pay themselves dividends, and alternatively, what kind of argument we might want to make for paying a salary? Again, we'll come back to the CPP piece, but outside of that, is there any reason you'd want to do one or the other?
Yeah, so there's a couple of reasons for each, depending on where you're at in the phase of your life cycle, as an example. So I'll start with favoring dividends. If your clients aren't familiar with the idea of the notional accounts, so as you get passive income that builds up in your corporation, or you get GRIP, that general rate income pool that allows you to pay out eligible dividends, these notional accounts, so refundable dividend, tax on hand. So if your corporation received passive income like rental income, interest income, those kinds of things, there's a piece of tax that they will get back if they pay out a dividend. Similarly, if they have a capital dividend account and they can pay out a tax-free dividend, those are actually much more tax efficient because you get this refund back from the government. So those are reasons to favor paying a dividend and clearing out some of those accounts. So that's actually one major reason that you would choose to pay a dividend, because of that tax efficiency. Now, any questions about that, or do you want me to jump to a major reason you might want to pay salary?
So I guess maybe what I'd follow up on with that is, in most cases, outside of maybe some really large asset sale where we have a really large amount going to the capital dividend account, or some really large passive income coming in most cases, if we're looking at paying dividends in those situations, is it safe to say that for most people there's not going to be enough flowing through those notional accounts that all of our income is going to be coming from that, but we're still probably going to have to decide between paying our regular dividend income versus our salaries, and that's just more or less of kind of supplementing when it's available?
Totally. So that's a great point. So there's a couple ways I would look at that. So first of all, I think it's important that we sort of break out, are we looking at compensation for this year? So as an example, if as a business owner I brought in 300,000, maybe I paid 100,000 to myself as a salary for that year, or I'm paying 100,000 as compensation to myself and leaving 200,000 in the corporation. So once that 200,000, a little bit of tax has been paid on that 200,000, that's going to be left in the corporation. And eventually the most tax efficient way to pay it out is a dividend. But if we're focused on that 100,000 today, client comes to you and your accountant and says, hey, Joe and Mr. or Mrs. Accountant, how should I take this 100,000? Should I take it as salary or dividends today? That's where we would then say, first, yes, let's clear out those notional accounts. Most people, if you have a diversified portfolio yielding 2%, you're right. Most of our clients, or the people that we work with, are not going to be able to have 200,000 of dividends, in which case, once you pay out that portion, then we are back to salary versus dividend. And then I would say salary potentially makes sense. And the reason salary makes sense is, one, tax integration, as we just talked about. So you save a couple dollars in tax. Two, you also get RSP room, which people look or undervalue when you consider the pure tax deferral. And then three, depending on what phase you're at in your life as a business owner, you might want to show income for income purposes, say the ability to qualify for a mortgage, debts, things of that nature.
Okay. Yeah, no, that makes perfect sense. So we mentioned that you're going to talk to us about the CPP piece of this decision and why CPP might not be a reason for us to avoid paying salary. So let's dive into those considerations, and we'll start with the employee credit.
Yeah. So just to give a quick, and I think this is relevant for everybody from a retirement, perspective, CPP, just so everybody understands, as you pay into it, you get this future entitlement. Like you get a component of your income that is guaranteed and adjusted for inflation upon retirement. You could choose to take it between 60 to 70, leave that for another time. But the idea is when you retire, you're going to have this fixed base of income that you can now draw upon, and it will theoretically always be there. So it's a safe asset that continues to adjust with inflation over time. So for anyone that says, oh, it's a tax, that doesn't take into account the effect that we get a direct benefit from it on the back end.
So maybe if I could jump in there, Aravind, could you just maybe we'll just dive a little deeper into that piece, and can you just kind of give us your thoughts in general? So you mentioned so it's not a tax, right? There's that benefit. How important and how much of a factor you think that benefit of having Canada Pension Plan is when it comes to enhancing or not enhancing a business owner's retirement plan?
Well, I think it's really useful in sort of two effects. The first is it's guaranteed. And as we all know, anyone who's been very successful in saving and accumulating and growing their assets from a mental standpoint, it can be really tough to let go of that saving feeling. And so you might feel that you can't spend as much of your personal assets, or you might be really worried about volatility and watching it go up or down. And so you might want to be more conservative to preserve the value that you have. This guaranteed income is something that you know is going to be there, which means from a behavioral standpoint, you can spend that a little bit more freely. And because you know that you have this guaranteed income base, it will also, in many ways, from a behavior standpoint, allow business owners and other retirees to feel more comfortable with the rest of their assets flowing up or down because they know they've got this steady stream of income that comes through every single month.
Perfect. I couldn't agree more. All right. So back to the considerations around CPP and why it's not as expensive as we might think it is.
Yeah.
All right. So I'll let you jump in. I think we're going to start. Well, we can start wherever you want, but we have the employee credit.
So for anyone who knows, CPP also has the enhancement. So there's two components to CPP that started a couple of years ago, and they're continuing to phase in over the next 2 years. So I do have more research coming that I'm working with another fellow colleague that we probably both know, Joe, Ben Felix. So he and I are working on some joint research on this. But so CPP is broken into basically, let's call it 3 pieces. There is the employee component, which is broken into employee credit and deduction, so the base and the enhancement. And then there is the employer component. So the employee component of 4.95% up to a certain cap gets the basic credit that we would all get on our tax return. So in Ontario, together, that's about 20.05%, 15% federal, and 5.05% provincial. So right away, as you're paying into CPP, that base amount gets you a tax credit back. Do you want me to go further about that? Any numbers that you want to put behind that, or?
I think as long as people understand, so tax credit essentially is getting you some money back in your taxes, right? So essentially, it's reducing the cost of that CPP.
100%. Actually, I'll pull up 2024 numbers just so we can give a little bit of clarity for any accountants or anyone who might be looking at it. Give me 1 second. I'll pull up what 2024's contributions are going to look like.
Perfect. Yeah, let's take a look at that.
Perfect. So, Joe, to give some numbers behind the employee credit, in 2024, the employee component of CPP is $3,867.50. Now, with that being said, of that $38,670 of the basic amount, so we'll use the basic amount, $3,217.50 qualifies for this credit. So to your point, for everyone listening, difference between a credit and a deduction and how that all works is you're not saving tax of $3,200. You're going to take that $3,200, you're going to multiply it by 20%, which means we're looking at roughly $640 of tax savings from a credit perspective. So right away, the big point that we can point at is when everyone looks at CPP and says, oh, I'm paying $7,000, $8,000 into it, whatever that premium amount is, that's not accurate because we're actually receiving some tax savings by making these contributions into CPP. So that's the employee credit. We get 20% that we're getting right off the top of about $3,200, $640 in round numbers.
Perfect. And then from there, we can probably jump right into the employee deduction.
Yeah, so that's not all that you contribute. I said 3867 for the base component, and then there is also the enhancement. And so to give a little bit of context or backstory for everyone so they understand what I'm talking about when I refer to the enhancement, basically what happened is up until I believe it was up until 2019, we had a flat 4.95% that everyone contributed as employees of a percentage of their income, roughly around 60,000, and it increased over time. In 2019, the government rolled out what they call the enhancement. They said people aren't saving enough for retirement. We need to help them save for retirement. So what we're going to do is we're going to have everyone contribute extra into CPP over and above the 4.95%. In the old days, that 4.95% that every employee contributes would get them about 25% of retirement income replacement when they retire. Under these new enhancement rules, the calculation would be 1/3 of that income in retirement. Just to give some context and some backstory there. Any questions about that, Joe, or anything you want me to add color to?
No, I think you're doing great. We'll keep going.
So once they rolled out this new enhancement, instead of that 4.95% and anything over that being a credit, they said, hey, the 4.95% will be a credit, but everything above that you're contributing will be considered a deduction. So just like when we put money into the RSP and the government kind of pretends that we didn't make that money, same idea here. When we make those extra contributions to CPP, we get a deduction for it. Now, where this gets a little bit more tax heavy, and I hope nobody's eyes are glazing over, is unlike a credit, which is like that 20% is 20% no matter what tax bracket we're at, the deduction is more beneficial in higher incomes. Because what happens is if I'm in the 30% bracket, then I save 30 cents on the dollar for every contribution I make. But if I'm in a 53% bracket as a business owner, then...
Sorry, Aravind, I just lost you there. I don't know if I can hear you. Yeah, you're good now. So I lost you at the point where basically you were about to talk about why deduction is more valuable than a tax credit.
Okay, perfect. So why the deduction will be more valuable as a tax credit. What happens is a credit, that 20% applies across every single bracket. We'll leave the surtax, which is in unique Ontario piece, to the side. But in general, that 20% or that $640 we talked about is $640 of tax savings, whether you make $15,000 or whether you make $50,000 or $500,000. A deduction, on the other hand, is tied to where you are at in your marginal tax brackets. So if you're at the 30% bracket, then a deduction saves you 30 cents of tax on the dollar. If you're at a 53% tax bracket, the highest tax bracket in Ontario, then a deduction is going to save you 53 cents on the dollar. Any questions about that?
Yeah, so just to bring that back together, I think what we're looking at is a deduction is reducing your income. So that's just reducing your right off the top, basically your top marginal rate. We're seeing that benefit. Whereas the tax credit is just multiplied by that same factor, 20%, no matter how much you make. So the deduction, again, being more valuable.
Exactly. And so not only does that 1% come into play, so that extra, roughly $600 or so, but now we have this new enhancement that's being rolled out, which is the second phase. I won't pour everybody to tears. But essentially what's going to happen is there's going to be an extra, increasing over time, another $500 to $1,000 that will qualify for this deduction. And with inflation, continue to grow over time. And so what's happening is, we're going to have an extra 500, 600, 700 over time. We're going to have this extra deduction. And if you're a business owner at a high enough tax bracket, say 43 or 53%, well, what that's worth to you is actually $500 after tax today, as it relates to CPP.
Yeah, that's perfect. Now, obviously, the other piece, and I think maybe why sometimes the argument's made that you want to avoid paying into CPP is the idea that as a business owner, you have to pay both sides of that contribution, right? So there's the employee amount the employee's paying, which you have to pay if you are a business owner or not, if you're taking salary. But then as a business owner, you're also paying the other side of that.
It's a great point. And I without getting into hey, if you're an employee, technically somebody's paying it, we'll leave that to the side and we'll just purely focus on how does it look to me as a business owner. And so if you look at that and you say, well, now I got to double it up, is it worth it? What you actually have to ask yourself as a business owner is, well, what am I doing with that money if I don't pay into CPP? And the only way I don't pay into CPP is I choose to leave that money in the corporation, flow it through as dividends, pay tax in the corporation, and then pay tax again on the way out. And so this is where two pieces come into play. The first is the employer component of CPP, even as an incorporated business owner, kind of functions as a pre-tax deduction. And that might break a few brains. So I'll start with, let's look at typical businesses. So with a typical business, if you're an employee working for somebody else, you get your income, you see your CPP contribution, but you don't really see the employer CPP contribution. When the employer files payroll with the government, that employee expense, the fact that they paid you salary, the fact that they, also paid your CPP, is a deduction to the business. And so when you are an incorporated business owner, treating yourself as an employee, the same thing happens. Those CPP premiums that the employer is making, they are a deduction to the corporation. So the corporation pays no tax on it, and the employee pays no tax on it, effectively making it like a pre-tax contribution. With me so far?
With you.
So that's one option. If we pay salary, the business gets an extra deduction to make up for it. If we go back to our original conversation about deduction versus credit, depending on where you're at, that deduction becomes very valuable. So all of a sudden, $3,000 or $4,000 pre-tax looks very different than saying, hey, I'm going to flow it through as a dividend, which means I'm going to pay my business tax on it. So if we use the small business rate, 12.2%, and then I still have to pay it out as a dividend to myself, in which case I'm going to pay anywhere from 30 to 50%, depending on what my tax rate is. And so that after-tax amount that I get to hold in my hand, or pay a little bit of tax, but then still I paid tax and left it in the corporation to grow, looks very different than giving it pre-tax with no dollars to CPP for that payout later.
Perfect. So can you just kind of think of everything we just talked about from the CPP standpoint? Can you just kind of give us your thoughts? So without any of the kind of the technical thinking, just what are your thoughts on why or if a business owner should pay themselves salary and take the CPP?
So in general, without getting into the numbers of the weeds, I think it makes sense to pay salary for a host of reasons, including the CPP. Because first of all, as we just saw in federal budget, I think this podcast is really timely, right? Tax diversification, tax and taxable income diversification just became a lot more important because we have no idea how the government is going to treat corporations in the future. And so being able to have this money that is kind of set aside with a known formula that they aren't really, could they mess around with it? Sure. Nothing is ever forever set in stone, but you know that they're going to, annoy or anger a much bigger population if they try to change CPP. So from a certainty standpoint, we have this known outcome with CPP. Second is everyone thinks that CPP is this $8,000 and increasing amount, but it's not actually when we think about after tax what we would have in hand. Third, we get to create RSP room with the salary, which means we can now take money, put it in an RSP, which is truly tax deferred, and it's going to grow without incurring any extra tax the way it would in a corporation. And then finally, when people say, hey, I could invest those CPP premiums myself and make money on it, there is that component of, okay, but like, where are you investing it? If you're investing that money in your corporation, then you're paying tax and you're subject to these future tax risks that the government has shown they're willing to do. And so in that perspective, I think the small amount of money for a fairly successful business owner, but hedging some of these other uncertainties all along the way makes a lot of sense. And then there are some other technical nuances that we still haven't covered that push in favor of CPP.
Okay. Now, one of the things you mentioned I want to make sure we touch on too is just what are your thoughts? And I know you've already talked a little bit about this, but I want you to go in a little more detail on your thoughts around investing the what people would call pre-tax dollars, which are not totally pre-tax dollars, inside of corporation versus creating that RSP space and using the RSP to invest for retirement.
So there's two components, one of which is I think everybody kind of understands, but they don't really think about, which is the idea of tax drag. So let's say you start with, let's call it $8,000 for simplicity's sake. You know, $8,000 of pre-tax corporate dollars. You can pay that $8,000 out to yourself as a salary. And because you're flowing it right into the corporation, that $8,000, it stays $8,000 all the way through to the corporation, or sorry, not to the corporation, to the RSPs.
Yep.
So let me recap that: $8,000 to yourself as salary, and then from salary straight to RSP. Because you got the income, but the RSP gives you the deduction, that 8 is preserved all the way through. And so now you have $8,000 in your RSP that you can grow, and you are paying no tax on the dividends, the interest, the growth, the entire time you're investing in your RSP. If, on the other hand, you put it in your corporation, you have to pay your small business tax, so 12.2%. And then whatever is left over, as it grows, capital gains are taxed, dividends are taxed, interest is taxed. And so what happens is, think of it as death by 1,000 cuts, or a bit of a leaky faucet syndrome. It's not a lot, but you are losing a little bit over time. So over a long enough time frame, the RSP does outweigh the corporation from a long-term growth perspective. And there's many other papers that have proven this. Jamie Gollenbeck has written a few papers on this. PWL Capital has written a few papers and graphed it out. So this has kind of been a tried and proven piece. So I think everybody knows that. But the one thing that people don't think about is pension credit. And Joe, for your business owners, if they don't have a pension, so if they don't have a government pension as an example, or something that is paying out a specific amount, and CPP does not count for this, if you have an RSP and a RIF, taking money from your RIF qualifies for the pension credit. And so you get this basic amount. It's not a lot, but it's on $2,000. You get about $300 of federal, and then you get your provincial. So you know, you're getting anywhere from $300 to almost $400 of extra tax savings through the RSP. So when we put those two pieces together, the RSP starts to look really beneficial versus a corporation for a chunk of money.
Yeah, I really want to touch on that because I mean, it's been countless times where people come to me and accountants talk to me. And I don't want to lump all accountants into one kind of group, but very often, you know, there's certain different firms, whatever. Anyway, they just say, you know what, we want to keep that money in the corporation. We pay dividends out because it's a lower tax rate personally. And then we just have those pre-tax dollars, which of course still there's tax paid on them and then tax paid all the way through on them. And we want to invest those, and it works like an RSP. But then, you know, we're not trapped in the RSP. So the only thing I would maybe add to that is, I guess maybe if I was going to try to find something to agree with in that argument, it would just be that if you might use that money for something within the business in the future, right? Maybe an acquisition, there's capital expenditures. So like if you're going to be using that money and it needs to be for some kind of future investment that isn't retirement, then that makes sense. But if we're talking about retirement planning from a tax standpoint, I just find it really hard to make an argument for investing in the corp before an RSP, until of course, you know, you've maxed out your RSPs. And I mean, obviously we can still take advantage of that I guess somewhat tax deferred investment, but it's not the starting point, I don't think. And I think you kind of just touched on that.
No, and I think you would appreciate this. Like that's why planning and understanding your client and the client and the corporation's goals are so important, right? Because if your client has a true grasp of their business, so I have clients as an example, their business is expanding. It was just two of them, you know, kind of like a construction business, and now they're seriously thinking about what kind of equipment do we need to buy because we want to, you know, build this out a little bit. So that's a great example where, you know, they come and they say, hey, we're going to make this money. Should we pay some into an RSP? And you would say, yes, but no, because if you have to borrow or lease in these higher interest rate environments for said equipment, and you were truly looking at like it makes sense to buy it outright or put a down payment, you know, that cash might be much more useful from that perspective. And so that's where planning and understanding their goals and what they're doing and how they're doing it makes a lot of sense. And that's why I think it's important that anyone who's working with, you know, business owners, especially with some complexity, they aren't just looking at one isolated component like RSP and corporation and investment portfolio, but what are the client's goals all along the way?
Perfect. So if we had to wrap this all up and somehow come up with we'll call it the optimal baseline strategy around business owner compensation planning, I'm gonna give it to you the way that I've heard it, and you tell me if you agree. And that would be that we want to pay salary for all the reasons you've already mentioned. We may deviate from that if we have some availability through those notional accounts you mentioned, like GRIP and the capital dividend account. But otherwise, salary is kind of our go-to.
Yes. May I add one exception?
That's what you're here for.
Your clientele, I think this is really important, because if they follow these rules, right? So let's say they have started out, they have paid salary, they've cleared out notional accounts, but if they follow these rules and they're getting closer to the end of their time frame and they're very successful, they may have actually already paid into CPP for the majority of the years that they need to. And so looking at that and saying, okay, well, I'm at a point now where paying into CPP actually adds no additional benefit because I've got my full years of room. And this is where that joint accountant Joe client becomes important. That's where looking at CPP and saying, do I have any extra benefit from CPP? Or if I'm working a second job where CPP is already automatic, that would be another sort of start with salary, but then look at these levers. And one of them would be, do I actually gain a benefit from CPP, or am I getting those contributions elsewhere? If so, dividends. If not, back to salary.
Okay, perfect. And then before we jumped on, you said you may mention something around old age security clawback. Did you want to add anything in around that?
Yeah, so really quickly, I think it's really important. So Canada Child Benefit on the younger end. So if you're a younger business owner with kids, and old age security clawback on the older end. But there are many of these government income tested benefits. Now, a little known fact is with dividends, while the amount that you receive in hand looks similar to salary, there is this component called the dividend gross up effect. And so what happens is, to account for the taxes paid in the corporation and equalizing it, they add a multiplier on the amount of money that you actually receive as a dividend. So if you receive $100, depending on the type of dividend, it could be anywhere from $115 to $120 in what is deemed the gross up. That 120 or 115 is what shows up on your tax return. Now, why this is important is that doesn't happen with salary. If you pay yourself salary, $100 is $100. And actually, because as we discussed, CPP deduction, $100 might actually be closer to like $93 or $97. That income gap between the comparison of salary and dividends becomes important when you look at these government income tested benefits. So that gross up means you would receive less OAS if you're in that clawback range. Or if you have kids and you're receiving Canada Child Benefit, that gross up means that you actually receive less Canada Child Benefit as well. And really, in a way, becomes an additional tax that penalizes taking dividends to a certain amount.
Yeah, and this is related to what you're talking about now, not so much related to our episode today, but I think a lot of people, not a lot of people, but there are people obviously doing dividend investing and try to base their entire retirement off dividend investing. And I won't go into diversification and things like that. But aside from that, that kind of can be an adverse effect on that old age security clawback too. I don't think people realize, right, is that everything you just said, that income coming in on their tax return is showing up higher when it comes to those like the old age security clawback potential.
Totally. And actually for business owners, I would say it's even more of a double-edged sword. Maybe now with the new changes to capital gains a little different, but keep in mind that you have to pay tax on those dividends in your corporation and or flow it out to yourself to pay tax, which means if you're growing it, like if your focus was, I don't need to touch this money, it's kind of like saying, well, I'm just going to pay some extra tax all along the way, which is really just punitive to your wealth versus, say, a deferred capital gain strategy, where if you don't realize any gains, you're not actually paying any tax, which means 100% of those dollars are compounding and growing versus paying tax on a chunk of it, which means you only have $98, $95, $93 compounding and growing because of that dividend effect.
Yeah. Yeah. No, that's great. So I think we went pretty deep on this day, and I appreciate all your insights, Aravind. Now, I know you're always putting out content, and I read it all. I love it. It's great stuff. Just keeps me on top of things. Where can people follow you if they want to get that content? How can they connect and we'll get all this info from you as well, put it in the show notes, but just for anyone just listening.
Love it. So I'm fairly active on social media. I would say the three main platforms that I spend most of my time on are Twitter or X, LinkedIn, and then I have a consolidated Instagram page, and I post my written content, videos, etc. there. If you're looking for a lot of the long form, if you want to get in the weeds, then I would definitely say check me out on LinkedIn. But you can engage with me on any of those platforms, and I'm happy to talk, share, collaborate, however needed.
Perfect. And we will get all those links from you, and we'll get them in the show notes. So retirementplanningsimplified.ca/blog, and you'll be able to find the episode on there. So Aravind, thanks again for joining us today. Appreciate it.
Thank you. Appreciate it, Joe.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode. And until then, we're here to help you simplify and succeed in your retirement planning.